M2 in the Fed had been correcting since
Ah,
2022, and
yes,
now we've made an all-time high. We've broken
right.
the 22 high, and that's before even the Fed starts cutting or stops QT. Or so I think this is quite significant too. Now with rates having gone down, I mean they have cut rates since September a few times. That's starting to pick up again. And that's despite the fact that they're
Yeah.
still running off the balance sheet. You know, they're still doing QT. They're supposed to stop it, I think, by June. But yeah, we'll have to wait and see what happens.
You're watching Capital Cosm. My name is Danny. Today's guest is Mario Innecco from the Innecco 64 YouTube channel. Mario, thank you so much for coming on the show, my friend.
You're welcome. It's always a pleasure to speak with you, Danny.
Yeah, likewise. It is April 28th, 2025. And we seem to have had a bit of a small correction in the gold price since last week. We did hit that record level of $3,500 magic number. Today we're back down to $3,300 handle. But I want to get your thoughts here, Mario. For you, what is front and center for you at the moment? What do you think investors should have on their radar screen right now?
Um, well, I think the ongoing tariff wars and what the Trump administration is trying to do, I think there's a lot of disruption from it because even though they have competent competent people in the administration, this has never been tried before, and they're finding out by the hard way that they have to adjust. And I see a lot more adjustments going ahead. I was reading an article today about how difficult it would be to transfer all the production of iPhones to the United States, and mainly because maybe 15, 20, 25 years ago, the reason companies went to China was because of the cheap labor. But now it's not just the cheap labor, it's all the supply chain to build an iPhone is spread out throughout China, Southeast Asia, and India. And to think that you can make iPhones in the US in a few months, it's not doable. And there's a lot of other things like that that are going to impact the markets. I've been reading, and some people might say, well, that's from the FT. They would say that, but that, and others, that there's a possibility of empty shelves in the US in the next few weeks. I saw that Bessent, the Secretary of the Treasury, said he's not concerned about empty shelves. Maybe he's been doing some prepping, but I think, yeah, the reason why I'm looking at that is because it's gonna make the rest of the world even more determined to try to hedge itself and try to have another, let's say, avenue to trade, i.e., use gold as the base asset and then trade amongst each other through their own currencies. And that's de-dollarization. So that's what I'll be. I think people should be watching. And I also think the stock market. You said to me before we started that whether I think it is a dead cat bounce, and I do. So I think the momentum structure, as per Michael Oliver, I don't know if you've had him. He still thinks.
I just had him on the last episode before you. So
Yeah, and I just read his weekend report. We're nowhere close to getting back to positive momentum in the stock market. So I would just batten down the hatches, hold on to your gold and silver, and be nimble if you have a lot of stock market investments.
yeah, you mentioned that the administration would have to make some adjustments. Can you kind of expand on that? What kind of adjustments do you see them making?
Well, all the different, one day they'll impose reciprocal tariffs, and then the next day they see that the stock market and bond yields are going up and the stock market is going down, and they backtrack. And I'm sure they're going to be doing a lot more backtracking going forward because, as I said, this is never done before. They're trying to fix something that has become rotten over the last 50 to 60 years. They're trying to fix it in a few months, and I don't think that's possible. And it's going to create a lot of problems. It's like moving furniture in an abandoned house and then finding loads of horrible things under the sofa and under the beds, and having to like adjust to that.
And from what I understand, Americans haven't really felt the effects of the tariffs yet, given that we still had inventory of the stuff that we needed from before the tariffs went into effect. I believe we start seeing the effects this coming month, right, in May. So the empty shelves that you're talking about, that could become a reality as soon as next week.
Yeah, and I mean, I just bought something off Amazon last week, and it arrived today. And I opened it. It's made in China. I'm in the UK, of course. Maybe it's going to not affect us because we haven't put tariffs on the Chinese goods. But yeah, I think it could. Like you said, companies, they stock up for a few months. And I saw a headline that there's not many shipping vessels leaving China for the US right now. So everyone's waiting to see. It's very difficult, I guess, for companies, importers, exporters in China, factories, to determine whether they can stay open, whether things are going to change in terms of the tariffs.
Interesting. Now, you're in the UK, Mario. You shouldn't, I mean, you're not impacted by the tariffs, are you?
No, I'm not really. As I said, we're not imposing tariffs on China or the people. And I think the US has imposed tariff on UK automobiles, manufactured here. There's not many of those anymore. Things like Range Rovers and Land Rovers and stuff like that, or Bentleys. But it will affect, I guess, the factories in the UK and the workers, I guess, a little bit. But other than that, there's not much of an impact, even though the government here and the chancellor, who's the equivalent to the secretary of the treasury, they're going to use these tariff wars as an excuse to justify, as an excuse for the weak economy that we have. Last week, they posted the budget deficit, and it's running at 6% of GDP, which you usually do during a recession. And you can bet they're going to blame Trump, the Trump policies for a lot of that. And it might be an excuse for the Bank of England to resume cutting rates because they kind of paused for now.
Right. Speaking of cutting rates, you have this ongoing drama between Fed Chair Powell and Donald Trump. Why is Powell resisting, do you think? Why is Powell resisting cutting rates? And why does Trump want rates to be cut? If rates are cut, I mean, sure, it stimulates the economy in a way, but doesn't it also bring back inflation?
Yeah, I mean, the other thing it does is that if you cut rates, it will weaken the dollar further. I guess maybe that's why. And then U.S. goods become a little more competitive abroad. As to why Powell is not trying to, is not playing ball. Maybe it's a little bit political because we saw that on September 18th last year, he cut by 50 basis points. And I think the economy was doing a lot better than it is now. And some people argue that it was because he was trying to help the incumbent administration. That's possible. The other reason is that he doesn't really know what inflation is, and he thinks that higher prices of imported goods is inflation, and it isn't. Inflation is like when you grow the money supply. and it results in higher prices of most goods, not every good. So I think that's what it is, and I don't, and I think the way Trump has been vocal about Powell hasn't helped. And I think he said, well, he's Mr. Way Too Late or something like that. He
Yeah.
called him. But then he came out and said, no, I've got no intention of firing him. Maybe it's because Besson had a meeting with Wall Street, a closed private meeting organized by JP Morgan. They said, well, give Powell some slack, and pause some of the tariffs, slow down with China, and then maybe Powell will cut rates. I think that's maybe what happened. Of course, it's only speculation on my part. I'm not. I wasn't there at that private meeting, of course.
But what good could come from cutting rates, even if the fact that we have multiple rate cuts already and the 10-year still hasn't really budged all too much? Scott Bessent's North Star is the 10-year yield, because that's what home loans are tied into, car loans are tied into. It's not the short end of the yield curve, it's the long end, the 10-year. So, I mean, what exactly are they trying to accomplish with this? I mean, if they are trying to bring back interest rates down, aside from a weaker dollar, it just, I mean, to me, it doesn't seem like it makes much sense to fixate on the short end.
No, I agree with you. And a lot of these people in the administration, maybe not so much Besant, don't understand that if you cut short-term rates, you could actually it could actually result in the long-term rates rising, because ever since the Fed cut rates in September, the longer end of the curve has gone up. So yeah, I don't get it either. But Trump is kind of he's got really opposite views a lot of times. He wants to fix things, but at the same time, he wants to keep doing what the Fed did in the past that led to all this problem of unsustainable debt, which is basically artificially low interest rates. So yeah, it's politicians. I know Trump is a businessman, but he's a real estate developer, and I don't think sometimes he understands the consequence of a lot of things that he proposes.
So you also said that we're likely experiencing a dead cat bounce when it comes to the markets. Why do you say that?
Looking for great deals on gold and silver, coins and bars from a company that you can trust? Then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
Well, because back a few months ago, you had that DeepSeek. And a lot of people thought that would really hurt the NASDAQ, the Magnificent Seven, and it has, even though no one has been talking too much about that. Now it's the tariffs that have caused this, and the markets have rebounded very sharply. I see Besant said that it's been the biggest recovery on record, but usually in bear markets, you do have big recoveries, like record recoveries, like you did in the 1930s and in 2008 and 2020. So I think it's a dead cat bounce. And as I said earlier, I was reading Michael Oliver's weekend report, and all the momentum structures are still negative. And that's why I like reading his stuff, because he doesn't just base it on trend lines, he bases it on momentum. And as I said, fundamentally, I think there's still a lot of headwinds out there for the U.S. and the world economy.
So are you anticipating a recession? What exactly do you see out there?
Well, yeah, maybe a recession is possible, and we had one in 2022, I think, but
Didn't
they
call it a
changed,
recession.
yeah, they changed the definition. And here in the UK, we growth is below around 1% year on year, but we're government is overspending by 6, and as you know, uh, government spending is part of the GDP equation. So these governments and central banks, they can do everything to try to avoid having a recession. But I don't think it's really relevant if we have a recession or not. I think things are still not good. But looking at the yield curve, we were inverted for a long time, and now it's disinverted. And usually, when that happens, we we usually see a recession within months.
Yeah. So I have a few charts here pulled up. I'll get the yield curve here in a second, but let's go ahead and start to take a look at the gold price and get your insights on it. Okay, so this is, I believe this is a June contract, but we are at 33.39, and you can kind of see, I mean, we've had a legendary run up from, I mean, it's pretty much been nonstop all, for the last year and a half, almost since 2023, really. And we are currently, this is the daily candlestick view, and we are above all of our moving averages, 20, 50, 100, 200-day moving, we're above all of them. How do you see the current health of the gold market right now? Have we run up too much too fast? Or if these central banks are buying gold, there's really no end that we can see at this present time to stop this rally.
Yeah, I mean, you're showing this daily chart with the moving averages. One way to get the market closer to the moving averages, I guess, is for the market to consolidate around a band and not go up or down too much. But yeah, I mean, gold has run up a lot. 2 weeks ago, gold settled at 33, I think 27, the spot price. Last week, yeah, we had a big correction. We reached 3,500, and then we corrected back down, and we closed at 33.19. So it's actually down only about $8 on the week. So it looks like it's taken a breather, but I personally think that there are a lot of people coming out, people that are not involved in gold, calling tops, and I think actually that's pretty bullish. But yeah, I mean, unless you trade gold, I don't think you should be concerned. If you're buying gold for the long haul, yeah, just use it as an opportunity to buy more dollar cost average. And I saw there was a headline, I think, or the cover of Barron's has a pile of gold on it, and it says gold rush, and people are saying, oh, that's really bad, it's contrarian. But if you look at the little what they say here on the front page, it says below gold rush, it says investors are loading up on the metal as a haven in chaotic times. How long can it last? And I think, yeah, Michael Oliver as well, he read the article, and they're actually they're not pushing for gold. They're saying that it's not a good place to be. So they're actually not contrarian. So that's how I see it. And I like to look as well, Danny, at the monthly chart, if you could bring it up. Yeah. And yeah, I mean that, and if you stretch it back as long as you can, Don't know how many. Yeah, you can see that. Yeah, it is bullish, but there's still a lot of room
Right.
up on that chart. And I've looked at this chart, taking the high from 1980 to the high in 2011. And last year, that line was coming around 2,700. So we've broken out of that. So yes, all I would tell people is that hold on to the bull. It's just like in a rodeo, the bull is really wild. You have to hold on to it. It can't fall off the bull. And I think that's how I see the gold market.
Yeah. So this is the logarithmic view of
Yeah,
it.
I look at the logarithmic. Yeah,
Yep.
that's much better. Yeah.
hmm Yes, but if you look at it on a nominal basis, I mean,
Yeah, it looks massive. It looks like I agree. That's why I look at it logarithmically. I
it
think.
smoothens it out, especially
Yeah,
from a
yeah.
technical analysis point of view. So let's go ahead and take a look at this. Let's go ahead and juxtapose the yield curve onto this and see if you can find any insights. So yeah, anytime the yield curve gets below a certain level, so hold on. Move to pane below.
Is that the 10-year yield?
It's the TYX it's a 30 minus a 10-year.
Oh,
So
30 minus the 10.
anytime it drops below 0, that means it's inverted.
Yeah, yeah.
And now it's uninverted. And yeah, you can see how it all plays out. So
Oh, the 2-year versus the 10, isn't it?
isn't TYX 30?
I would do more the 2-year versus the 10 instead of the 10s versus the 30s. But if you
What's the ticker symbol for the 2? TY?
TU, I think.
TU. TUX?
TU, no, just TU and then the month, I guess, or
Gotcha.
why don't you just 2-year, do 2-year and 2-year note future, maybe.
Yeah. 2-year note. Yeah, that's a 2-year note, but we need a yield. But anyway, let's go ahead and just look at this for now.
Yeah.
TYX minus TNX.
Yeah, I hadn't looked at that relationship. Yeah.
Yeah, and so you can see so we came down, we got down below 0, and now at the same time, when we were uninverting, the gold price is shooting up.
Yeah. Well, yeah, maybe it is calling for a recession, this inversion. And the other thing is, well, a lot of people expected back in 2022 when the Fed started raising rates, or 2021, don't remember exactly when, that as interest rates went up and yields went up, that gold would crash. But if you look at back in the 70s, we had rising yields and gold and silver went up. So I think, yeah, this is a sign of stagflation, even though I think the Fed this time around will probably use yield curve control to keep yields lower, because the debt is so massive, is much bigger than in the 70s. The national debt in the 70s was like 35% of GDP. Now it's more like 135%.
Yeah. And then I also have the M2 money supply. So gold divided by the M2 money supply.
Yeah.
And so this is the nominal view. It's not a logarithmic view. I'll put on
Yeah,
one
yeah.
in a second. But you can kind of see where we're at today. So this is looking at the price of gold relative to the amount of money sloshing around into the system.
Yeah, it's still very low.
Yeah, especially when you look at the 80s.
Yeah.
When you get a logarithmic view of it. I mean, even if we put a logarithmic view, it doesn't really change much.
No, even in 2011, it was a lot higher. And I've noticed, Danny, if you can bring up a M2 chart on the Fred website,
Yeah.
I noticed that we've just made an all-time high, because the M2 in the Fred had been correcting since 2022, and
Yes.
now we've made an all-time high. We've broken
Right.
the 22 high, and that's before even the Fed starts cutting or stops QT. Or so I think this is quite significant too.
Very interesting.
Yeah.
Yeah. So we went down. So we went down from 22 trillion down to 20 trillion. I
Yeah,
remember people making a big deal out of this as if it
yeah,
was the end of the world. But
yeah.
we've
They're not going to let it correct that much because that's the whole this whole system. You have to have the money supply growing. I think that blip there, the correction was just like they said, "Oh boy, we need to slow down a little bit."
right.
But I'm
So here,
sure, yeah,
yeah. So here's a question. So you've got. Let's go ahead and zoom this in a bit. So you've got the 10-year here down below. You've got the money supply here up above. And so we peaked here, but we peaked here in money supply, this area. But as you can see, yields continued to go up until we bottomed. And now the money supply is going back up. So my question is, doesn't it appear as if the reason why we saw this dip in the money supply to begin with was because yields were going up, meaning people were taking their money, taking their cash, and putting it into treasuries, which aren't accounted for in the M2 money supply.
yeah, and also the cost of financing was rising, so people and companies, corporations weren't borrowing as much, so there's not as much currency and credit being created. So that's right. But now, even though now with rates having gone down, I mean, they have cut rates since September a few times. That's starting to pick up again. And that's despite the fact that they're
Yeah.
still running off the balance sheet. They're still doing QT. They're supposed to stop it, I think, by June. But yeah, we'll have to wait and see what happens.
Mm-hmm. So we also have the gold to silver ratio here, and we are pretty much in record territory, or just about, aside from two occasions, one being COVID, which is really a black swan, if you will. The other time we were at this level in the gold to silver ratio was back in 91. And yeah, and so let's go ahead and take a look at what gold did while the gold to silver ratio hit similar levels that we're hitting today.
And I
So
think also in the 1930s, it got near 100 as well, gold silver ratio. But
yep. So gold pretty much started to go down in this case in 91. Doesn't mean it will this time around, but just from historical perspective,
yeah,
started to go down. And then in COVID time, we also hit a peak
yeah.
where gold continued to rise. Gold was outperforming silver, and today it's the rising gold price here that's extending out the legs. So
Yeah, I mean, it's some people think that one of the reasons why this ratio is so high is because central banks buy more gold than silver, and the public, I guess, isn't really involved in the precious metals yet. Maybe a little bit in silver, but it won't make much of a dent. But I saw that the silver deficit now, I think it's been running for 4 years. Annually, it's the size of a Olympic-sized swimming pool. So I don't know. I mean, I'm still bullish silver. Historically, bull markets in gold are usually followed by silver, but this time around, it looks like gold is going on its own. But I still expect silver to catch up with gold. And I don't think I could be wrong, but it's all about probabilities, I guess, in markets. I think we're not going to go that much higher than 100, even though I've seen people like Luke Groman. I think he thinks it's going a lot higher, this ratio, even though he's still bullish silver, but he thinks gold will do much better. And that's why I have both gold and silver, and I try not to sell one for the other. I just try to get out of fiat currencies.
right, and then let's also finally take a look at gold. So this is gold relative to the S&P. So gold priced in the S&P, and yeah, so this is the logarithmic view. The nominal view, just kind of give you guys an idea of
Yeah, a lot of room,
the
huh?
magnitude. So I mean, we are not even. I mean, we've barely gotten off the mat here. We've got 2 big candlesticks, and that's about it. But back to a logarithmic view. Well, yeah, what do you make of this? Are we? Do you see us? You mentioned probabilities. It seems like the probabilities portend to a mean reversion back to wherever the average is here, maybe somewhere around a 1.5 level as opposed to a 0.6 level.
Yeah, no, I mean, if you look at the bottom in that ratio, it was in, I think, August 1999, which was the top in the Dow Gold ratio, which I look at a lot. And yes, the central banks and the governments were able to stop the credit bust with all the QE after '08. And that's why we had the recovery in the S&P relative to gold. But I think now it's headed higher, this ratio, i.e. I think gold is on its way back. And it's still very much under the radar. So I agree with you. We could go a lot higher in this ratio. We could even go through the high from 2011, I would say.
Oh, so that was a 1.7 level. So assuming that the S&P stays constant, remains constant, you would need a 3x in the gold price to get back to that level. But I mean, you could also reach it by a collapsing S&P as well.
Yeah, or they could both still
Some
go
combination.
higher, but gold could go up faster than the S&P.
Mm-hmm.
Yeah.
Yeah, but if we're not anticipating a dead cat, well, if we're anticipating a dead cat bounce, let's say, then the odds are that the S&P.
Yeah, that's right. But if they come out, the central banks and governments, and throw the kitchen sink at everything, then that they could do that after
Mhm.
the cat dies again, and then they
Take the second bounce.
resuscitate the cat. Who knows?
Yeah. Okay. Well, I want to get your thoughts on the DXY. DXY is below 100. We're seeing some weakness in the dollar here, despite the the collapsing stock market, the weakening stock market. Typically, you would see an increase in the DXY. In this case, no bueno. Why do you think this time is different?
Well, I guess the tariff situation hasn't helped the dollar, but the dollar index is mainly a basket measuring the dollar versus the European currencies, the yen, the UK currency. There's no yuan or other currencies in there, and it was created back in 1973 at 100, even though it goes back further because they can back date it. And it started, as I said, started at 100, and we're pretty much at 100 52 years later. So yes, it does affect the price of gold a little bit, but I think ultimately I wouldn't really put too much weight on the dollar index because, like in 2008, the all-time low just above a 70. When that happened, gold was at $1,000, and here we are. The dollar index, dollar's gone up, and gold is tripled. So yeah, that's the way I see the dollar index, but I think it's losing a lot of momentum here, and we could see it go a lot lower. We could see it go towards 80, and I think that would help the Trump administration, would make it much easier on exporting, because that's been the whole problem. The dollar's been too strong, but at the same time, usually the administration says that any administration says they're for a strong dollar policy, but maybe not this time.
Right. And now I want to remind people in the audience who may not know, because we have people from all types of expertise that do watch this show, that DXY is the dollar's relative strength relative to other currencies. So collapsing DXY could mean a dollar weakening against the euro, the yen, or some combination of both of those or other currencies as well. So It's a
Yeah.
very interesting time because the currencies overall, they're all weak. They're
Yeah.
all losing value. And the fact that the dollar is losing more value relative to a composite of everything else, that's very telling.
Yeah, I mean, back in '73 when they started the dollar index, it was at 100 and gold was at $85. So all these currencies have lost um, value versus gold. And as you mentioned, the euro, I think, is almost 60% of the weighting of the
Yeah.
US of this index. And recently, the euro has rebounded quite sharply, mainly because the Germans decided to rip up their fiscal rectitude and spend a lot of money. And a lot of the stock market in Europe is rebounded because of that. And I think that's one of the reasons the dollar index has gone down. And countries like China and others, they're trying to diversify away from holding treasuries. They're going from the fire to the frying pan and buying European government bonds, and they're all denominated in euros. The eurozone bonds, not the UK, of course.
Yeah, well, this is probably outside of both of our pay grades, but what do you make of this alliance or relationship that's beginning to form between China and the EU? Because China really sits, if it were to really metastasize and manifest itself, I mean, China would be smack dab in the middle between Russia and Europe. I mean, can't they, in a way, create some sort of peace between the two if they were to continue to grow in maturity?
Yeah, I mean that would be good, and I think prior to 2022, that's what was happening. Germany was very close to Russia. They did a lot of trade with Russia. There's a lot of German companies in China, and to be honest, I think the neocons in the US weren't very happy about that, because if you have a strong Europe, a strong Russia and China, and they're all working together, that's not in the interest of the neocons in the US. Maybe Trump doesn't care because he said he wants to focus on the Western Hemisphere, the Monroe Doctrine.
Right.
So maybe that will come back, and maybe hopefully that will help Europe make some kind of peace with Russia, even though right now it doesn't look like it. We have the new German government, I think, taking power on May the 6th, and I think they're quite hawkish against Russia. So we'll have to see. But yeah, it's fascinating, all the new, people, different countries trying to build new relationships. Like I see now that the US is trying to get India, sorry, to be more involved with Apple and iPhones. There's even talk that Brazil might be involved. So it's almost like the US is trying to dilute BRICS. But at the same time, China is trying to get closer to the EU. So it's all in flux.
Yeah, they're all trying to recruit to their own side. Well, hey, it's been a pleasure having you on, Mario. Anything else you want to talk about before we wrap up here?
Well, there's a big headline that came out earlier today that there's been a huge power outage in Spain and Portugal, and it's disrupted everything in this day and age of everything being done electronically. That's something to think about. And my conspiratorial mind wonders if that's like a warm up for Klaus Schwab's cyber pandemic. Who knows?
Well, he's no longer in charge anymore. I don't know if you heard.
Yeah, I did, but I'm sure the policy there hasn't changed much at the WEF.
Well, they got a new guy in, and I believe he was like the CEO of Nestle, and yeah, he's got the one eye thing going on, and it's very interesting.
Yeah, he doesn't want you to have much water, does he?
No, he's what do you need water for? Water's for plants and the animals.
No swimming pools.
No. Well, I mean, if you watch It's kind of weird, kind of funny, because I don't know if you've seen the movie Idiocracy. So like that entire premise of that movie is you go into the future and everyone's kind of dumbed down and they don't drink water anymore. They drink Gatorade. so, all right. Well, thank you so much for coming on, Mario. Guys, be sure to check out Innecco 64 on YouTube. Anything else you want to plug, Mario, that I can post down in the description box below?
Not really. I mean, I'm on X as well, at Innecco 1964, but that's YouTube.
All right. We'll have the links to your X and your YouTube down below. Guys, if you enjoyed this podcast, give us a like and comment. Go, Mario, go in the comment section. Disagree with anything, that's fine too. Let me know what you disagreed on. Drop me a comment. Let me know. I do read the comments. And then finally, subscribe to the channel so you don't miss another episode. Subscribe to my Substack if you want to support me that way. CapitalCosm.substack.com. And I will see you in the next episode. Bye, guys.